All right, Jeff, it seems like Bitcoin is trading in this like range. It's going from 100K to like 115 and back, just back and forth, back and forth. Is 100K like this new base and there's consolidation and we should kind of think of this as a negative thing where we can't break out to the upside? Or actually, is this a really positive thing? Because there seems to be this like persistent bid of institutions and large capital pools who are just saying like, we want to buy anything below 100K. You know, we're buyers of Bitcoin there.
Right out of the gate, the question is whether 6 figures are still expensive or whether 100,000 has quietly turned into Bitcoin's new base camp. The picture emerging from Jeff's conversation is that this is no longer a purely retail market hunting for moonshots. It is an arena where giant pools of capital have decided that anything below 6 figures is a buy zone. If that is true, then investors today are not only watching a chart, they are watching the formation of a structural floor that could make sub 100,000 prices increasingly rare.
The demand and the put, if you will, as you've described it, is definitely there. So that's something we should take some relief in. Nonetheless, it has been discouraging that we've had many peaks to troughs drawdown this year over a mainstream cycle than otherwise we should expect. I think there's like 8 different counts of drawdowns at this point where we can't expand outside of like a 20% range. And Bitcoin, as we know, needs a little bit of volatility to make breakout moves. So the question is, why is there selling pressure at any given time? And, one of the metrics that I think is really interesting, and Glassnode does a really great job presenting it, is this metric called short-term holder realized profit to loss ratio. And that metric actually hit 0.2 earlier this week. What that means is that 80% of those who have been acquiring Bitcoin recently are underwater, and they're the ones that are selling. So this is not the same narrative of the giant whales that have been sleeping for 15 years and coming to market and selling, thousands of Bitcoins at a time. We're continuing to see that kick in, but there is a little bit of capitulation, if you will, with short-term investors who came in as well. That I think is healthy, because those are generally the same people who come back to buy when there's momentum of a breakout. So that money can actually be more of an accelerant in the future.
The choppy range around 100K is not just noise. Jeff frames it as a transfer of ownership. Short-term buyers who rushed in near the highs are now underwater and selling into that institutional bid. That creates the repeated drawdowns everyone complains about, but it also moves coins into stronger hands that are comfortable holding well above 6 figures. When those same short-term speculators come back in on momentum later, they are no longer leaning on the 100,000 level. Instead, they become the rocket fuel that drives price away from it.
And the reason is because so much of, I think, what we're going to see for Bitcoin going forward will be in sync with institutional capital, because it has now entered the mainstream era where the flows we're talking about, the next level of capital flows is really coming from that channel. And those investors are much more in sync with like global macro credit cycles than they are with like, the block itself and experiencing the halvings. They don't really care about that. Mm-hmm. And so I do think genuinely the 4-year cycle is broken, but it doesn't mean we're not going to have cycles. It's just the cycles probably correlate more to what people think of as risk on and risk off assets.
Once you accept that Bitcoin now trades on institutional rhythms instead of retail halving lore, the idea of a 6-figure floor starts to make more sense. These buyers care about liquidity, inflation, and credit conditions more than block subsidies. That does not mean the end of booms and busts. It means those swings are now tied to broader risk cycles, and the size of the capital base supporting Bitcoin is many times larger than it was in past eras. In that context, certain price zones become strategically important, not just technically interesting.
We are hitting highs, hopefully with the equities market. Like it's so close to surpassing 6,900 again for S&P. And gold too. Hey, it's been on a bit of a climb. And I think it's going to hit 420 pretty soon there. Again, 4,200. And so if those things hit, both risk on it and risk off, where people are just wanting to find a way to save capital, that is kind of, I think, the bat signal, if you will, for Bitcoin to perform.
Here, he ties Bitcoin's next leg to a wider backdrop. When both stocks and gold push toward highs, the message is that money everywhere is looking for a home. In that environment, having an asset that straddles the line between growth and protection becomes powerful. If Bitcoin is increasingly treated as that bridge, then the point where large allocators step in and say, "Enough, we buy here," may naturally settle around six figures and then migrate higher over time.
It's predominantly because you're going to find most of the young people very unhappy. You have to imagine the young people are already so disadvantaged. They graduate from college with so much student debt that they already feel like they're not earning enough opportunities to pay off that debt. No less the idea that then you're going to be a first-time home buyer when you're 40 years old, to pay off your home when you're 90 years old, when the average mortality in this country is 70. I mean, that's basically saying you're not going to pay your home until you die. And then you'll hear some boomers say, that's fine, because actually the home will just get passed on to their children. No, they're not. These people are not having kids. If you're in debt for the rest of your life till you're 90, what on earth would you think the benefit would be for you to have a child so you can then throw your own debt to the next generation, right? These are pretty evil things that are being discussed at some level.
The conversation zooms out from price charts to the lived reality of an indebted generation. If the solution to broken housing is a 50-year mortgage that chains you to payments into old age, traditional wealth paths start to break down. In that world, an asset with strict supply and global liquidity is not just a speculative play. It starts to look like one of the few credible ways to step outside a system that keeps extending your debt horizon. When enough people feel that pressure, the willingness to part with scarce digital assets at levels like 80K or 90K can fade quickly.
Now, if we go and we take a look at another thing that has been suggested as a potential solution is, why don't we just give people money? Like, socialism is now the all the rage in New York City. Washington, D.C., let's give out $2,000 stimulus checks. We'll call them tariff dividends. Last time this happened, stocks went up, Bitcoin went up. I mean, it was friggin' bazooka. This is amazing for asset owners.
Bring it.
It was not so good for the bottom 50% who didn't own assets. Very high inflation, lots of problems there. I don't know if they're actually going to do this, but just the insinuation, the announcement, the potential. I felt like everyone had come in from the wild. They had, stored their horses away, taken off their cowboy hats. They were getting ready to sit down, take a nap, and all of a sudden, $2,000 stimulus check. Yeah. You say, everyone start putting the cowboy hats on, get the horses, like, let's ride again, right?
Oh
Jeff's story about cowboy hats back on captures how sensitive asset prices are to money printing. Even the hint of fresh checks sends people scrambling back into risk. If this kind of policy response becomes a repeated pattern rather than a one-off experiment, then you get a steady inflation of nominal prices. Levels that once seemed extreme can become ordinary. In that environment, the window of time where six-figure Bitcoin is common can shrink faster than people expect.
Why are they settling now? They're settling now because they know stablecoins are coming. And they know that there is actually a giant competitor ahead that is basically going to take all their market share because you can't charge 2.5% for every swipes. And that's great for Americans, right? Whether you believe in crypto as privacy, permissionless blockchain, whatever. Like, it is great that stablecoin is coming because it will, in the end, impact consumer better for having more competition in this space, and we should laud for that. So I always go a little back and forth on like what the motivation and mission of crypto is, and the thing that I think is my North Star is it improves people's lives. If it improves people's lives in whatever kind of dimension we're measuring it, then I think it's a success.
This is where the rails and the reserve assets start to merge. Stablecoins push legacy giants like Visa and MasterCard to settle decades-long lawsuits and rethink their fees. Crypto infrastructure is no longer an abstract idea. It is reshaping consumer finance. Once millions of people are using digital dollars over these rails, the mental gap to saving in the hardest asset on those rails gets smaller. As that shift happens gradually, the structural demand for Bitcoin increases, even if day-to-day sentiment remains noisy.
In the end, payments is a two-sided transaction. For someone who's selling it, someone's receiving it. So in the most neutral sense, the hope is that whoever receives it then keeps it in Bitcoin too, and they will be able to accrue value. And in some sense, this also allows the possibility for many commercial companies to become Bitcoin treasuries themselves, right? Which is an incredible thing. If you can own Bitcoin on your balance sheet as a corporate, whatever small business you may be running, the outsized impact that can have for you, for your business survivability in the future, if Bitcoin continues to pace its price, is humongous. And now we've provided ultimately that optionality for thousands of merchants out there who now can just actually take Bitcoin.
Taken together, Jeff's comments sketch a simple but powerful idea. Short-term holders are being flushed out while institutions and businesses quietly build a base around six figures. Policy choices around housing, debt, and stimulus keep nudging people away from cash and towards scarce assets. Stablecoins and new payment rails pull crypto into everyday life, while merchants and corporates gain the option to turn themselves into miniature Bitcoin treasuries. If that process continues, the idea that we will never see 100,000 again stops sounding like hype and starts looking like a natural consequence of the system we are building. So after hearing Jeff's framework and following the logic from housing to stimulus to stablecoins and merchant treasuries, where do you land? Do you think we are truly living through the last chapter where 100,000 Bitcoin is common? Or do you expect one more deep reset before six figures become the floor for good?